The well-known challenges presented by the prolonged and devastating war in Europe, together with its knock-on implications for broader Europe and energy security across vulnerable economies, softened and yet volatile commodity prices and high inflation are having a significant impact on the mining industry, hurting margins and cash flows. Added to the uncertainty around the intensity and duration of global macroeconomic volatility, the much anticipated tailwinds from a Chinese economic recovery have not yet been realized, and the continued increase in interest rates by the US Federal Reserve contribute to the lingering retreat of global markets and softening of commodity prices. Securing a sustainable future remains a key priority for governments and businesses around the world. This translates into intensified opposition to coal mining and coal-fired power generation. So too, however, has the need to ensure that the future supply of critical minerals is secured in order to meet the rush to net zero emissions target by 2050. Given all the market dynamics in play, it is essential that companies have the balance sheet strength to navigate the volatility and uncertainty. This means adopting a bias towards cash preservation in anticipation of headwinds. The preservation results in underinvestment in new projects in our sector and slower M&A activity in the industry. Although we've seen several high-value transactions within the M&A landscape, this has largely been driven by a few majors, concentrated on scarce, operational, Tier 1 assets. We also see governments of critical minerals producing countries altering the playing fields through the proactive introduction of structural adjustments and policies to discourage exports in favor of domestic manufacturing. And this is happening in Africa, by the way, and to control prices at the same time so that they can capture more value from these minerals. This poses a significant risk and greater competition for these minerals, thus demanding disciplined and well-considered investment strategies to meet the urgency required for future supply. This provides the backdrop against which global energy businesses must operate. And while issues around energy security present opportunities for us as a business for further uptake of renewables by customers, given this enduring state of polycrisis, we recognize that M&A decisions will need to be focused on building resilience and long-term value creation and not as an immediate reaction to prevailing volatility. The dynamics which have played out over the first half reiterate that rapid and unpredictable change will continue to unfold. We've seen weakened thermal coal demand from Europe due to sufficient gas stocks, combined with materially lower natural gas prices and improved renewable energy performance. We saw thermal coal prices slip over 60% from record highs of 2022 to a two-year low of $99 per ton. So it is important to remember, however, that current pricing remains stronger than those we've achieved pre-2022. So if you look at the line graph on this slide, it illustrates how our portfolio of commodities deliver robust and complementary market performance, thus cushioning our margins against the cyclical nature of these commodities. You can see that the API4 price averaged at $130 per ton in the first half, compared to the average of $264 per tonne in the second half of last year, whilst iron ore fines averaged at $118 per tonne versus $101, respectively, during this period. In addition to this, our domestic supply, especially to Eskom, further protects our margin from global market volatility, making our stock much more defensive. Changes in the global trade flows were evident as Australia resumed supply into China in the first half after it had been halted since December of 2021, whilst the Russian supplies to Europe and Japan reduced materially. This is why we believe that our market to resource optimization interventions must always be engaged. And you'll be happy to hear that India remains as a strong importer of our low coal from South Africa, and it has been as such in the past half and remains a key market for us as a company. We've continued to experience recurring locomotive unavailabilities due to reported cable theft, derailments, operational inefficiencies, and vandalism. The current softer pricing environment has rendered the trucking of coal, which is inherently a suboptimal transport alternative, no longer feasible. This has further limited access to RBCT and alternative ports. Lower Eskom demand from our Grootegeluk mine that Kgabi will talk about in this first half is not from a lack of Eskom's need for coal, but due to prolonged periods of unrepaired equipment at Matimba, which may be an indication of skills availability and possibly prioritization within Eskom itself. However, we have no doubt that these volumes will be required for Medupi and Matimba, and we're very confident that Eskom will resolve short-term disruptions to this offtake. The worsening electricity supply shortage has negatively impacted the South African business and also economic growth prospects. While the supply shortages present opportunities for our energy business, grid constraints, however, remain a key challenge in the rollout of renewables. We are proactively investing in and developing sites with grid capacity and appropriate energy resource levels to offset these constraints. We are committed to a transition journey. If you look at our ESG is core to our business and a driver of value creation across all our markets. Decarbonization of our operations and through our entire value chain is an urgent imperative to reduce CO2 emissions, which will result in the additional benefits of avoiding market barriers, fines, and the loss of social license to operate. By accelerating our decarbonization plan, we can also realize cost savings, partnership opportunities, and favorable financing terms. Decarbonization is central to our strategy and looks to contribute meaningfully to the energy transition through renewable energy generation for our operations and other customers, alongside the production of critical minerals. The transition to clean energy hinges on clean energy technology supply chains to source critical minerals because steel from manganese and iron ore will be required for wind turbines, plus more copper for transmission lines and offshore wind power, and even more aluminium from bauxite to support solar PV will be required. So we are aware as well of the increasing scrutiny and pressure that coal companies are subjected to. This manifests through the exit of some international investors from the sector, while multinationals reorganize their portfolios. As a result, we are happy to report that we have revised our Scope 1 and Scope 2 emission targets to 40% compared to what we've reported before of 43% by 2026, due to the change in the divestment of Leeupan Mine. We have finalized our value chain Scope 3 emission analysis with the majority from our Eskom supply, very much around 97% of our Scope 3. Hence, we need to pursue other Eskom suppliers to partner with us in dealing with Scope 3 emissions.